Yeah. So first of all, what do we need here? We need, as a guidance, the lecture notes, because in this case we can see what to do. So practically, as a reminder that we have to build up something which collects all the cash flows from the different years. Then we have to discount it with the weighted average cost of capital for each year. And also we have to determine some kind of salvage value and also discount it easily because we have to define the salvage value after 5 years. So yeah, and we don't have to care about this initial outlay because right now we're just evaluating the company, not the purchase of the company. So if you had initial outlay, it means that we're already putting some cash on the table that we would like to purchase some percentage. Right now we are not doing it, so this part is 0. Yeah. Okay, so let's create an appropriate design. So first of all, let's say we have to calculate the free cash flow. And let's start with the present value of cash flow because this is the major first part. So okay, so first question is that can you see this, or it's much better, I think. Is this visible for you in the back as well? Okay, cool. Then we have to define the next step. So we always have to follow stepwise. So 1.A, then we have to define the free cash flow. Right now we are cooking and following our cookbook. Just instead of pancakes, we are creating a valuation. So and also we know that if we are designing this thing and this thing is developing in time, and also we know that we have different, let's remove this here. We have different years with different cash flows, so it's much better to keep it dynamic. So let's say that, okay, we are defining years already. And then we are defining all the cash flows, free cash flows, everything, all this stuff for each year. And then we just, it will be way simpler than adding together or doing other manipulations. So we have to move this here. And also I zoom in. So in this case, we can see that what to discount later on. Okay, so in the case of free cash flow, we have to follow, we have these following steps. So first of all, we need EBIT, then we need taxes. Luckily, in the case of taxes, we have only corporate income tax because we have no idea about municipality tax, so we will ignore it. And gain interest, paid interest have to be added as well. And so let's call that these things. So okay, maybe this way. Bold is nice because it shows us that it's important. And the EBIT will come from the profit and loss statement sheet. So here you are, from K19. In the previous years, we always did it in MATLAB, and it was way harder. So this is also my first time to build it up. Yes, in Excel. So next step, taxes. We know that Excel doesn't like minus, so we have to put it into quotations. Otherwise, if we start with minus, then it thinks it's mathematics, and yeah. And Here we can see that we have corporate income tax and other main components of this one, and then we have gain interest, paid interest multiplied with the corporate income tax rate, which we know is this. Yes, all the cookies, please. If we are looking on France in the KPMG database, wow, they developed it a lot. In the past, it was just a stupid table, and now they develop it so I cannot see anything. Whatever. So Google said that, yeah, this is 26.5%. I don't have numlock. Yes, so 0.25. So, okay. Practically we have something. In the case study it's bigger. So, yeah, for now it's smaller. Okay, and then we have to also highlight this. There are reasons why I'm not teaching taxation. So, okay, so that was this part, but after that still we have to add gain interest multiplied with the CAT rate and with paid interest multiplied with the CAT rate. So let's copy these names. And also formatting them nicely, because now it's italic, not bold, because we are in a subgroup. And do you have any gained interests at all? Or we are looking financial revenues, 0. This is the closest thing what we have to gained interest, because we have absolutely no cash reserve right now. So yeah, this is 0, and then we can roll it through all the years. Why don't we have? Because at the end of the day, we are making such profit, so we should have gain interest. Yeah, because it's zeroed out, it's not intelligent. Okay, so we can see that this is the cash reserve here, and this cash reserve, I think it's supposed to have some kind of interest rate. I know that we are in the zero interest rate environment, but still it's not elegant. So let's say that here financial revenues, we will define this cash reserve have an interest. Ooh, what kind of interest? Yeah, because this is the triple bay interest rate, and if we are, we cannot use this. We are not putting or, yeah. So bank deposits have always lower interest rate than corporate bonds, unfortunately. So let's refer it here. Yes, it's not working. I know. Oh. Okay, right now I give it something. Now it's still dead. Okay. Why are you doing this? Yes, I know it's linked together. That's the reason why we are doing this. The other question is that, is this thing still uses decimal points or decimal commas? Ah, decimal commas are still used. It doesn't want to cooperate because it's referring back to itself. Okay, then. Okay, practically this is right because we are generating it in this year, so and the next year it will have some increase. So let's say this thing. Just we will set this up later on. Just we can see that at least if we have 3% of interest, which is still big, then we have the print screen from Reuters, so we can see that if we are purchasing AAA rated corporate bonds with or double A rated bonds, because French is only double A rated, then it's 3.2%. That was good guess. So still we get some earning, but at least we are not investing into the same risk category because it would be stupid. So 3.24%. So at least we earn some money. And now we can say that there is this thing, but also we know that this is decimal comma. Yeah, in Central Europe, in Germany or Austria, Switzerland, Czechia, Poland, Hungary, we are always using these decimal commas. I don't know why. So it has some historical reasons. I don't know what, but I was thinking if everything is switched to English, then it will also switch to English. Percentage. And still we have to multiply it with the CAT number. And also we have to add the paid interest. In this case we don't need any kind of modifications because we just paid interest. And we have to multiply it also with this number, and let's use a dollar mark because in this case it will be fixed. So again, from the profit and loss statement, the paid interest and multiplied with the CIT rate, which is here. And then we can add all this thing together. And now we can see that, okay, this money will be used in the valuation. Then the next thing, until this point it's clear that what we are doing. So, okay. Then we don't care about spending on investments. I mentioned yesterday that we are handling it completely a different way. So let's focus on depreciation. So last week, when we were defining our beautiful rocket, we were mentioning that we don't care about depreciation of the rockets because we are using them up within a year one way or another. So even if we are reusing them and it's not exploding, then still our turnover will be big enough to use it up. So maybe one or two rockets or first stage will survive for using it for the next year. But in this case, I don't think so. It would be reasonable to have any kind of depreciation on them. So let's keep the depreciation on the already existing infrastructure. So in this case, we can see that long-term assets. We have investments. Okay, we don't have to make depreciation on this. We have property, and this property is depreciating happily. Okay, minus 18. We already have depreciation in the profit and loss statement, so it's good because in this case just we have to refer on it. We don't have to do anything. Depreciation. Okay, next thing. Floating capital. Oh, I hate floating capital calculation. This is the terrible part. So, what do we need here? Current assets minus short-term liabilities. So, let's take current assets. Short-term liabilities. And we already have the current asset category here, so we just have to sum it up. And some cash, loan and receivable. It's interesting that how do we so we are providing loan to someone. Oh, I can understand receivable. So sooner or later we get some money from our clients, but this lending is quite strange because it's a significant amount in our balance sheet. And with my colleagues, we are always arguing about other category. Let's keep this one because it's even more. So it's completely untransparent what is inside. So let's say that we are not adding the other category, just cash, loan and receivable and inventories, because we know that this is behaving like what's expected. And short-term liabilities, and here just the payable. I have no idea. So we can see that current liability, other categories, the biggest and the major element in the entire balance sheet. So what are they doing in the name of accounting? So maybe it can be some tax optimization from parent company, that they are moving some assets and creating liabilities to optimize tax payments in the background, or I don't know what is happening here, but we can see that it's at least strange. So maybe also we should eliminate this loan and receivable because it's my biggest fear that if we are keeping this tax optimization components in, that it will bias everything so much. Let's just use what we know. That okay, this and this, because it would increase the free cash flow so much that practically we will not see anything from the actually made money. So let's avoid biases. And then we can see that, okay, now it's representing the inventories, that it represents the changes in cash flow, and it's much more like floating capital than it was with the artificial, or at least doubtful elements. Also shrinking the size, because in this case we can see that which components are the main components and which are not. And then if we have everything together, then we have the free cash flow. Oh, then what was the... Yes. Okay, so in the case of current assets, it was reduced to the cash and the inventories. In the case of the short-term liabilities, this is just the payable. And after that, we just have to take the difference between short-term assets minus short-term liabilities, so nothing different after that. Just we are not including these bogus elements. Which is it good? Okay. Then let's go forward, and now we just have to add them together. So we know that EBIT minus taxes plus depreciation plus the floating capital, which can be sometimes negative, it can be sometimes positive. So let's add it because it's clear, and we can see that. So that's why I wanted to exclude this loan and receivable, because this 2000 would outshine everything in this, and yeah, it would be completely useless to calculate free cash flow. Then the next thing. So yes.
Why depreciation is sum? Why do we sum depreciation?
Because depreciation is just an artificial thing in the when we are calculating the profit and loss statement, because practically this is happening from accounting point of view, but from financial point of view we are not paying anything. Yes?
Sorry,
yeah.
What after like C9?
Floating capital, C10. C4 minus C5 plus C9 plus C10. Yeah, if I go this way. Yeah.
So where did you get the taxes, the minus taxes from?
I just
C5.
C5. I just added them together. Yes. It's just a sum. That we have these three components, so that's why.
Thank you.
Better. Okay, we can continue. Okay. And now we have the free cash flow. So the next point, 1.b, is the weighted average cost of capital. And to the weighted average cost of capital, we need the following items: shareholders' equity, long-term liabilities. So let's start with shareholders' equity. So in the case of shareholders' equity, we can just check the balance sheet that what is there. We have common equity, we had retained earnings. It's strange that we have so much retained earnings while the company is absolutely not profitable right now, but maybe in the past they were, just now it's over. So plus the two things. And we know that if we are profitable, then the retained earnings will increase as well, so it's good for the business. Maybe I should reduce decimals. Just some small formatting to, yeah, now it's more suitable. Next point, that still we have to estimate the RE. So the expected rate of return from equity. And in this case, we need the ordinary CAPM, so let's write it here that we will collect the data because of this. So we need RF, so it's 10-year bond rate from France. Then we need RM, that's the stock market index from France, and we need the beta. From the Demodaran database, and after that we have all the ingredients. So there is a free database called stoku.com. I like it because, okay, half is speaking some Polish language, but it doesn't matter because I am absolutely not speaking any Polish at all. But if I'm clicking well, not this one, obligacje. Yes, this is long-term bond in Polish language, and we can see French long-term bond yields from the last date. It's 2.4%. And 0.00. And we are creating this as a percentage because it looks nicer. Okay, it would be much more elegant to look for forward positions in this interest rate, but yeah. Okay, then next thing, stock market. Okay, so practically we can add the link here that we were using it because it looks nicer, that was the source, we just not imagined it or made it up. The other thing is indexy in Polish language, and we can see the CAC index. And if you are clicking on historical data, so that's why I like this so much, because we have, okay, we need it just from the last 10 years, please. And now we can see that, if we are averaging this thing out and we are smoothing it with a logarithmic mean, then we can get nice results. So let's download this. And fortunately, this is a CSV file, so in data, new query from file, from CSV, we have to read it in. Why to upload Excel? I don't know why, but some people prefer CSV. Load it. And then Also, I will add the URL here. And now we have closing data for, I don't know how this appeared here, but okay, whatever. So let's use the opening and not the closing level. Yeah. And valuation, and let's put it here because so in this case we see what is happening with this data set, and obviously we could say that, yeah, but if I'm taking the difference and divide with the first value, then I would have some kind of rate of return. Just we can see that this rate of return alone, it's quite useless. So 1 year we have -6%, another year we have nearly 30% for market return. So somehow we need an average. Just the problem is that if we are using, is this mean in Excel? No? Average? Yes, average. So we could say that, okay, it's 9%, just if I'm excluding this year. Oh, it's still 8 point something. Okay, this is not the Hungarian stock market, so. But still we can see that it still highly depends on sampling. But let's use exponential smoothing, because at least I can show it to you. So what is exponential smoothing is that we are just putting this on power of it's annual data, so it should be the lambda 0.94, I think, because we are using higher lambdas with daily data. And yeah, I was writing here exponential moving average, but oh, this part is missing from the entire documentation. Sorry, guys, but yeah, okay. Okay, but it's still increasing, so we have to do something with it. Yeah, we have to multiply it with. No. Yeah, sooner or later I realized just I'm doing it this once in a year, and yeah, this is how does it work. So we are taking the number. Let's increase it, then clicking in it. So we are taking the number, then we are multiplying it with 0. So with the lambda number 0.94, and then we are putting it in the power of the time which was passing by. So this one is on 1, and the reason is that once we are increasing, so we are referring not just number here but externally, then obviously if we are going back in time, then this 0.94 will be smaller and smaller, because now it's on square root, now it's on third, now it's on fourth, and so on. So it will be smaller and smaller, so that's why it starts to decrease the past values. So that's why this exponential moving average can be beneficial for us, because in this case we can see that this past 17% is now it's way less important because it happened 10 years ago or 9 years ago actually. So now if we are calculating the average, then we can see that it is much more reasonable. So it's 7%, and because we reduce the importance of past information in the data. So now we can say that let's use this percentage. As an RM. Yes.
Where does the 0.94 come from?
Yeah, this is coming from the Chai book about econometrics, and roughly the first time Goldman Sachs published exponential moving average, the usage of exponential moving average in the early 90s, and they used it not just for this occasion, but also they used it for when they estimated the importance of past correlations or past volatilities on the market.
So it is constant.
Yes, it's a constant, and it just if you have annual data, then you are using this lambda. If you are using daily data, then it will be 0.97. And I was thinking that there is some kind of scientific proof behind that, but so there is the child econometrics, which is full of equations. So they are proving everything, and also in this book it says that this is good. So they were not reasoning why it's this thing, or there were no mathematical proof behind it. Just they are using this, or so that's why I don't know, but. But this is the industrial number what we need to use. Okay, and since we have only past data, then that's why it should be kept as a constant. So let's fix it. Yes, in this case, maybe we could create some forecasts for the market rate, and then we could just create some simulations, but I don't think so that we would like to do this. Right now we have to build it up, and then if we want to stress it, then we can stress it later on. Still we have time for that. Okay, Demoderan beta. Then the Demoderan beta. But why are you overriding this? Okay, so again, I have to. Yeah, remove this part of the. And data. I mean current data. Total data by industry sector, and we have to focus on Europe. And we have aerospace and defense, and we are using the average unlevered beta, so this number will come with us, and we will use it happily. Okay, and let's put here also the URL. And then we can build this thing up because now we have all the necessary information, so we can see that risk-free rate plus beta multiplies bracket opens market return minus the risk-free rate return, and then we have the RE, which is constant, and yeah, it's not that elegant, but good enough. So we can say that we have to expect at least 7.5 or 5% from the bond. And also we need long-term liabilities. In the case of long-term liabilities, it depends on the company, because at the beginning the company did not have any kind of debt. I created the debt because I was able to see that I'm in such a losses. So practically the debt is the sum of these two numbers here. If I'm going back, then you can see it already. No, it had 2.5 million euros as a debt, and then I added these 2 years to cover a bit related losses. So and then we will just keep it there. I don't want to repay it, because if it expires, then we'll issue another government bond, another corporate bond, and then it will be useful for us. And then still we need RD, which is the interest of our debt. Yep. And so these are the official numbers, but should we update this now or just keep it this way? Well, let's keep it this way. It will be even more funnier when we can see that what is happening if we are increasing the interest rate. So it's not changing anything. And then finally we can calculate the RVACC. Because now, okay, so we have the RA, and then it's weighted average cost of capital. Yes, I know that you are not MATLAB, but please. So yeah, it's a weighted average cost of capital, so that's why it have to be multiplied with shareholders' equity, but divided by the shareholders' equity plus the debt. And then bracket closes, plus the interest of the debt multiplied with long-term debt divided with shareholders' equity plus long-term debt, and that's all. Do I forget something? Yes! I nearly forget the CIT rate. Yeah, this is how you can 1 minus this. I will reopen it just, and I have to also fix this because otherwise it will. and creating a nice percentage. Okay, so it takes a lot of place, so yeah, now you can see. Yes, because we have to take the return on equity, then we have to multiply with the weight of the equity inside the equity plus debt. And you can ask the question that why we have to do this multiplication with the capital, with the corporate income tax ratio. The reason is that with debt payments are always reducing the tax payment because it practically generates additional expenditure. So it's not like the case of equity when after equity we are always paying after paying tax. And in the case of the debt, it doesn't matter that the company is able to pay any taxes, so are they in profit or losses, they have to pay whatever it takes, otherwise they go to default. So that's why we have to compensate with the tax rate. Just it's hard to, or sorry, it's easy to forget sometimes. So that's why we have to add it here. Okay. Okay.
So
Yes.
where does the long-term liability come from?
Long-term liability is just coming from a from our losses, and the company already had a 2.5 million long-term debt. I just added that, okay, if we know from the business plan that this will be the calculated loss, then just let's add it here and we will collect some cash.
So we don't include the 399.
Yeah, no.
Why? Isn't it like also included in the long-term liability?
Yeah, the other. Because it's still other. So I don't know what kind of long-term liability is this. So it can be also an equity-like thing that maybe it was provided by the owners of the company without any interest payment. So it's if something is untransparent, then at first let's keep it outside our scope. After that, still we can test it. So there can be a second iteration when we are adding all the others. But at first, let's see that if we just add the transparent data. Yes.
Isn't it about like if the liability is payable or intangible?
It can happen. It can happen. So since in the entire balance sheet it is just other, that's why we have no idea. But usually we are skipping these parts. But speaking of intangible, this will be our next problem. So, because we have the salvage value in the second half. So, 1 point B, but this is second salvage value. Oh, I have to use this formatting. Come on. Okay, so salvage value, and here we have to define what are the marketable assets on long term? So yeah, so real estates, vehicles, anything that we can sell on the market, and market value. So what do we have here? The problem is that we have not so many. Okay, so we know property. Okay, we have some investments. We can assume that it's still okay, but we have intangibles, and this is a lot of money. So the problem is that but salvage value or these things will just, we want to sell them, or we have to sell them only in the last year, so we don't have to make this dynamic just for the 5th year. And also we should not forget about cash reserves, because so how much money do we have in the last year? So this. And after that we can, should we compute here? So let's have this third point for discounting, and 3.A, the discounted cash flow is added. So for each year we have to pick this number divided with 1 plus the VACC on the power of the time, which is located here in yellow, and which was, I hate when Excel does this, that it's falling out of equation. So okay, still not visible, so I will, yeah. So, and then if you are just rolling it sideways, then it will define itself again and again for each year, so it will be quite easy. So this is just ordinary present value for any future cash flow. It's okay. Okay. Let's roll it sideways. And then we have just to sum it up. Sum all these things in the future. And we can see that altogether it's a nice sum of money. And also we have to add the salvage value. And here we only have data here, so this number plus this divided by 1 plus the VACC. On the power of 5. So 5 years later, if we are selling all the assets, this will be the present value. So at the end of the day, we can say that let's keep it nicely. So estimated fundamental value will be this number plus this number let's do some formatting again. So at least my setup, obviously yours will be different, but my setup was 4.5 billion euros. And we can say that this is not the result of making a lot of cash. This is the result of having a lot of intangible goods. So if we would eliminate this, then it would be reduced drastically. So intangible is the 12. So if I would take out this one, then we would see that actually this is not the price of the company. So that's why we have to test different setups when we are doing valuation, because one item in the balance sheet can completely derail or it can bias. So obviously if you are doing it in real, then you are going deeper and deeper into the financial account. You are the financial report, annual report. You are checking not just the financial part, but also the non-financial part of the report. So you are looking for what is inside or behind these numbers here, because right now we can see that this can be the value, at least how I'm making cash. And let's save it, not forget to save it. Okay. We can ask the question that can we create or recreate the baseline scenario, because right now we don't have a baseline scenario, so I cannot say that what was the added value of my perfect launch vehicle. So I will save it, and then we will create something which looks like as the practically still you get the vehicle, or were you changing the setup? You were changing. Okay, so let's build. Yes.
Can you go to the value table?
Yes. Of course. First I will close this one, and yes.
So the long-term asset and the cash reserve is, we will take only the value from the last year.
Yes. Yeah, because we are expecting that we will sell the company. So what would happen if we would liquidate the company 5 years later? So we are allowing it to make cash, and then we will sell it. And practically we are just calculating the present value for all the possible revenues in this case. Okay, so I'm reopening case study. Okay, so this is the legacy engine. So we have to use Volcane. Not the Indian one. But we need only one of these, so the number is good. The price is not good. Price. 10. It's cheaper. It's rubbish, but cheaper. Okay, fuel type, it's hydrogen. The nightmare of NASA right now. Okay, fuel requirement. Yeah, it's so funny that, okay, hydrogen is practically the lightest element on Earth, so we can see that, oh, we need just tonnage, it's useless, but practically the fuel tank will be bigger than in the other cases because it's absolutely not a dense material. Okay, no, this way. And also we need some fuel price and also probability of explosion. I think probability of explosion is the same. Yes, so I use a different, not a different learning curve. And amount of solid rocket boosters, yes, it requires 3. Yes, because in one setup they are requiring 2, in other setup they are requiring 4, so on average it requires 3. How to solve engineering problems with ease. Okay, fuel. A lot. Okay, to keep it nearly 0 temperature, so that's why, I mean 0 Kelvin, not in Celsius. So that's why it's not the hydrogen is expensive, but not just the hydrogen is expensive, but also. The entire vehicle, and it's not able to fly again. So it's 0, 0, 0. And it's also, we don't have to change this because anyway it will just goes up. But why is this so cheap? I forgot something. Okay, it's aluminium, so it's at least not carbon fiber.
It's not recoverable.
Yes, it's not. So we are building the legacy vehicle, which is planned to fly, but it's still way too cheap.
Is the
Yes. No. I was thinking that it was reflying again and again, and that's why we are not able to use the original. So this cell is not good. It's not good. It's not good because we have to. Say that we have to fuel it up, build it up again and again 10 times to have 10 launches. Now these are the good numbers. Oh my god. The problem, or the tragical part, that this is the reality. So right now, European taxpayers are financing things like this, or a vehicle like this. So stages to build. This is going through automatically. Now we have to go over to the original launch numbers. Yep. And we have the launch price. Okay, guys, so in this case, the question is what will be the value? You know that there is this meme when the guy sits on the chair and I feel not safe. Then this is the case because this company only worth something because of the salvage value. So right now we can see that the cash flow which is generated is absolutely negative. Oh my god. I don't know what will happen in the next 5 years with ArianeSpace, but we simulated everything. So we have the original launch numbers, which is right now in their books. Maybe it can increase by 1 or 2 launches, but that's all. These are the official revenue numbers. Okay, probability of realizing revenues, maybe it can be biased, so it can be a bit higher, but yeah. So not the brightest future, but at least we can see that even what I build, the monstrosity, creates some added value for the company. So that was my vehicle, and if you are looking from shareholders' point of view, even this bracket full of rusty components can perform way better than this. Okay, so do you have any question? Obviously I will upload the Excel sheet so you can adapt to your own strategy. So not in the sample assignments, let's create a new one. Okay, only flat line. Okay, so I save this one and closing this one. I save this one and closing this one before I'm saving or uploading something without the most recent version of it. And now you can download it. So even if you are not able to follow something or there was a mistake in your Excel sheet, now you have the appropriate version. And you can update this as you want. You can test it back and forth. But next week we will go on and we will see that how the probability of default is probable at the company. So how can we estimate probability of default and also did we survive? But practically, if we are looking on these numbers from the original setup, it will be better. So I have not so many doubt in this case.
Professor, so does this model can be used for every kind of company?
Yes. Yes.
What about commercial banks?
In the case of commercial banks, it will behave the same way, just you need special features like adding capital requirements related to the different lending risk categories. So you have to connect it to Basel III capital requirements, and practically cash flow generation will be the same. You have to modify the profit and loss statement a lot because in this case you have to focus on the interest margin and also the commission type revenues. And so if you are changing the profit and loss statement, after that the valuation will be the same because still you have to define the different cash flows, you have to define the salvage value, so that part of the process will be the same. but the profit and loss statement will be at least I would highlight different things in there, or even in the case of speaking of banks. So in this case, you have to be careful because in the case of shareholders' equity and retained earnings, there will be also the Basel capital requirements. But Basel capital requirements can be provided in equity, or it can be provided by long-term loans, which are not cannot be refundable. So you are not able to pay back before expiration. So that cannot be due, and it can be sometimes it can be 5 years or it can be 20 years. And this is also behaving like an equity in this case, so you have to add it also to the equity when you are defining VACC. But otherwise, yes, and also because banks so due to so sometimes they are preferring themselves for non-performing loans, and that's why you have to look for this active and passive what is the name? Always told me this so many times, just yes, accruals. So there is this active and passive accrual when you know that you have losses in the next year, and then you will already creating some savings ahead, or when you know that you will get extra revenues in the next year, and also you have to add it to the balance sheet. And in the financial sector, this number is way bigger than elsewhere. So also you have to add it to any valuation, or you have to be careful that not maybe not to add it when you are calculating the current assets and also short-term liabilities. That I don't know. In this case, I will check some related book or article which focuses on banks, but or ask the people in accounting that what is their opinion. Should you include it or not? Yeah. Okay. Are there any further questions? No. Then thank you very much for your presence. I hope that. Okay, it's but we cannot do it otherwise. So it's typing into Excel and build it up. So this is the way. So see you next time. Tomorrow or tomorrow. No, I don't. We don't have green finance class tomorrow. So next week. Last week of September.